Welcome to the 22nd Financial Math Symposium. We will be starting in a few seconds or in a minute or so. And I'm going to ask the chair of the department, Washington Mia, to say a few things.
So hi everyone, good morning. So I'm Washington Mia, chair of the mathematics department. I'd like to welcome you all to the 22nd edition of the Financial Math Quant Symposium. So this is an annual event that has been very important to the professional development of the students in our FIMath program. So very special thanks go to the organizers and to the external participants who contribute to the symposium in many different ways, through talks, as panelists, through direct interaction with the students, and many other activities. So I'm going to be very brief. So now I'd like to invite the Dean of Arts and Sciences, Sam Huckabee, to officially kick off the symposium. So Sam is a mathematician, so he knows our department very, very well. So during his tenure as dean, he has been a very strong supporter of the department and of the symposium in particular. So it's a real pleasure to have him join us today. So I hope you all have a very productive meeting. And with this, I'll give the microphone to Sam.
Thank you so much, Washington. And it is true what you say, that I've been aware of and involved with this festival for many, many years. Going back to the outset, and a little bit different role now that I'm dean, but I'm happy to take part. So welcome to everyone. It's my privilege to join you to say a few words. The first of these events occurred back in 1998, and therefore we are into our fourth decade of the financial math event. The name has also changed. It used to be called Financial Math Festival. Now, of course, it's the Quant Symposium, maybe a more appropriate title for this day and age. Excuse me. The field has evolved as well. That is the practitioners and the researchers being involved. For example, we would not, I do not think 20 years ago, would we have had presentations with the words machine learning in the title. It's a different type of era, and as technology changes and as everything else changes, of course, this type of an event evolves with it. Something entirely new this year, of course, is this virtual platform, but of course we are getting used to this. We've been all over the world, certainly in academia, have been doing these types of gatherings, whether it be conferences or seminars or classes. We are fortunate to have with us a distinguished speakers and panelists from the quant world. And as the day unfolds, you will hear formal introductions of each of them. Meanwhile, to all the visiting quants, welcome and thank you for participating. It is unfortunate, that we are not able to host you on campus here in Tallahassee. We're having beautiful November weather here. And so we're missing out on that unless we live here and can walk out the door. As Washington mentioned, we are indeed pleased to be able to offer this symposium year after year. It serves as a premier event for the financial math program and its students. And the financial math program involves more than just mathematics. Statistics is involved, computer science, even other colleges are involved. And so it really is an interdisciplinary program and has enjoyed great success over the years. Well, this, for the most part, concludes my set of remarks. And I know that you have a full day ahead of you and are eager to get started. So I want to thank you for your attention, and I hope you enjoy the Quant Symposium this year. I'm going to now toss the microphone back to Garai Octon for his comments. Thank you so much.
Thank you, Sam. Thank you, Dean Hakuba, for your comments. And once again, welcome to our 22nd Financial Math Symposium. And as Dean Hakuba mentioned, we are sorry we are not able to host you in Tallahassee, and that's why I changed my background to an aerial shot of the campus. It's the beautiful Landis Green. Now, I want to thank Dean Hakuba and my chair, Washington Mio, for supporting this symposium for all the years. Yes, this is the 22nd one. We really have done this 22 times in the past. And I want to thank Ling Zhu, who is the co-organizer of this year's symposium with me. I thank our speakers, Christian Homescu, Nick Costanzino, and Steve Pennington for agreeing to present a talk in this year's symposium. I also want to thank Marina Balzac from Citi, Tampa, and Daniel Weingart from Wells Fargo, New York City, who will be joining the job panel at the end of the symposium. The financial math is one of the 4 areas in the Department of Mathematics, one of the 4 graduate areas. And currently we have 37 students in the financial math program and a total of 127 graduate students in the department. Our financial math students, our financial math alumni have had positions in the industry, in the financial industry, as well as academia. You can get more information about the program by visiting our web pages. Now, please keep your microphones on mute throughout the symposium unless you are the speaker. If you have a question to a speaker, please write the question in the chat box in Zoom. At the end of each talk, one of the moderators will read a few questions from the chat box depending on the remaining time. And these talks are recorded and they will be available on the YouTube channel of the Department of Mathematics. You will receive an email after the symposium with a link to the YouTube channel. Now I want to introduce Alec Kirchhoff, who is going to introduce our first speaker. Alec has been the director of the Financial Math program for many, many years, and we owe much of our success to him. Alec, I'm muting myself now.
All right, thank you, Garai. It's my pleasure to play the role of introducing our first speaker of the day here at the symposium, and that would be Dr. Christian Homescu, who is the director of the Chief Investment Office at Bank of America. And Christian has been a good friend of the program for quite a while now, although this is the first time that he's actually been able to join us at the symposium as a speaker. And he knows about us because he's an FSU PhD. He graduated from FSU in 2002 after previous study in Romania and France. Although he didn't get a financial math PhD, and that's because it was too early. Our first financial math PhD wasn't until 2004. So being born a little too early is something none of us can do anything about. We don't blame him for that. But Christian is an expert now in a variety of investment technologies and systems. He's basically had quite a many number of years experience as a senior quant with lots of knowledge of lots of different investment related areas, wealth management, AI and machine learning applied to a variety of different problems, including risk, asset allocation, portfolio attribution, derivative pricing, hedging, scenarios, stress testing, you name it. Very experienced professional, and it's great for us to have him here giving our first talk of the symposium. Today's talk is entitled Machine Learning for Quantitative Investment and Wealth Management, Opportunities and Challenges. So thank you and welcome, Christian.
Thank you. And I'm sharing the screen right now. and it should be well, top of the screen. So this is about applications of machine learning in investment and wealth management. First, to describe what I mean by investment and wealth management. Essentially, these are the investment strategies which are medium and long term. And medium and long term means at least 1 to 3 months, if not longer. We have portfolios like retirement portfolios that may go even 30 or 40 years in the future. And this is going to be different compared to trading. So I used to be on trading until about 5 years ago, because the type of data is different, the type of requirements are different, the requirements from regulators are different in terms of the client sort of advice. And this makes it challenging to apply methods that actually were shown to work relatively well in other areas. You have the slides, so I'll not be able to discuss many of these topics. However, you have the slides and you can ask me questions during this meeting and afterwards. And you can also ask me questions any other day. There are essentially 4 major areas of applications of machine learning in general. We have classification and pattern recognition, network analysis and clustering, forecasting and prediction, and then reinforcement learning. So the ones that actually are working relatively well right now are the first 2, classification and pattern recognition, and network analysis and clustering. Primarily because, for example, classification and pattern recognition, it is using a lot of alternative data. And depending on the type of investment strategies and the types of portfolios, one may be able to use such data. I will talk a little about how network analysis and clustering is quite effective, especially within the context of portfolio optimization. Reinforcement learning is getting definitely is a very hot topic right now in machine learning in general, and I will describe how it can be applied, how it actually is applied within investment and wealth management, particularly within the context of goals-based investing. Forecasting of time series is a very important topic for us in the industry. The problem is that and I'll talk about it why, machine learning does not work well or well enough for forecasting of the time series that we have for investment and wealth management. And I will describe later why that happens and other practical applications, and in particular, I will also focus on the practical challenges which are seen in the industry in terms of application of machine learning. For the usual disclaimer, and as I mentioned before, I will actually be starting through, going to a lot of topics directly without going into much detail. You have the slides, and there are quite a few slides right now. There are more than 175, also 70 slides. So then you can actually ask questions based on it. Now, it's what happens is that there are a lot of opportunities in terms of using machine learning, and it's about the data available. It's about the fact that machine learning actually can capture better nonlinearities, can actually have a deeper dive into the dependencies of the data. Right now, even compared to 2 or 3 years ago, there are many more packages available in Python, in R in particular, to implement various methodologies, and actually have platforms like TensorFlow or others, which actually have quite good performance. The problem is that even if all those things are true, and machine learning was used and it is used successfully in various areas of finance, in particular trading and short-term investment strategies, it's not that clear even for them, but for those areas, but it's not that clear for, especially for machine learning, for investment and wealth management, because again, I'm talking primarily about medium and long-term investment strategies. There are actually very recent books, and I'm mentioning those books in the bibliography. And the argument here is that machine learning should not be used as a standalone tool, but rather to complement and to augment the classical methods which are currently used. And these are some of the advantages that I mentioned. The problem is in the same time that one cannot simply say, I'm going to take the machine learning algorithms, I'm going to take the financial data, put them together, and I'm going to end up with financial machine learning. Lopez de Prado made this point for a few years right now, and he has 2 good books. And then the same point is made in other very recent books that were published this year. The challenges are, and I will discuss about them at the end of the presentation. So this is a summary of the challenges. There are a few more with details in the last section of the presentation. So what happens is that the financial time series have stylized features which are not easily captured by machine learning algorithms. The data may not be sufficient. In many cases, it's not, because, especially for forecasting, because we have at most daily time series. I'm working on multi-asset investments. So in the best case, we have daily time series. We have sometimes even weekly or monthly. The intraday data is primarily available for equities, but that is only one asset class. There are, right now, we are working on more than 70 asset classes to have them in the portfolio. For forecasting, actually, it's challenging in terms of just using regular machine learning. It's either one has to combine the machine learning with statistical methods, and I will talk about it about that in a few minutes, or one has to devise specialized machine learning algorithms which are for this type of time series. The other major challenge is that there are strong regulations, which is good for client financial advice and for client portfolios. And in the same time, especially within the context of machine learning, right now regulators are asking that much more about, especially explainability. It's explainability and interpretability, but right now it's much more about explainability. And explainability for majority or vast majority of the machine learning which are useful is not great as of now. For here, this is just a description of the applications currently of machine learning in investment and wealth management, and I will you have them in the slides. I will touch on some of them. For this section is simply describing what I found to be the most useful in terms of references for various topics related to machine learning, and again, you have them here. For classification and pattern recognition is the one that is right now working the best, in particular using alternative data. And given the time constraints, I will not go too much to it. I just have here various references in terms of what somewhat works. And I'm saying somewhat because the alternative data right now is used much more for short-term investment strategies and for shorter investment strategies. And in some other cases, it is combined with the financial time series to provide a better investment strategy or a more robust portfolio. For I should sort of also provide a very small overview in terms of how the investment process works in the industry. And again, I'm talking about medium and long-term investment. So essentially, the industry is doing this in a two-stage process. The first stage is done in terms of asset classes, like let's say large cap equity or fixed income government bonds or commodities. or foreign exchange, or hedge funds, or private equity. And then the second step would be the implementation stage. At the end of the first stage, one would end up with a portfolio, which is, let's say, 60% large cap equity, 30% fixed income government bonds, 10% commodities. In the second stage, one would implement that portfolio and would manage it using investment vehicles. And investment vehicles is a large category which may include individual stocks, individual bonds, mutual funds, hedge funds, private equity funds, the financial derivatives, annuities, and actually more. We also right now we have asset classes which are something like art or even wine, the one that I put in the beginning. So the second, in order to do this properly, one has to categorize the investable assets, these investment vehicles, and machine learning is definitely useful in doing this in terms of classification and pattern recognition. For in terms of text analysis, that is becoming definitely useful, and that is where right now there are much more powerful machine learning packages compared to even 2 years ago, and it is definitely used in the industry for in various directions. One of them is to improve the investment strategy by looking at company documents, regulatory documents. The other one would be to actually ensure compliance. I have seen another case where one is going to do ESG investing to sort of to rely on this text analysis for better ESG investing, and I'll talk about it in a short moment. It's definitely quite useful right now, and it's going to become more useful because more data is going to be available, and the packages are already quite good in terms of NLP. For social media and news is getting more and more used. It is right now used much more for trading and for short-term investment strategies. It is starting to be used within the context of investment or wealth management in a few directions. One of them will be nowcasting that I will discuss a little later. So ESG is this environmental, social, and governance type of investing, and this is definitely a very big area within the industry right now. I have to give you some numbers first. So right now, well, as of the end of last year, at a conference, there was a number that was mentioned in terms of what is the AUM for investment and wealth management in the world. Right now, it is about $100 trillion, 99 or 100. That was at the end of last year estimated. It was also estimated that in 2025 it would be about $125 to $130 trillion. And while that number may have definitely changed based on what happened this year, it's still extremely large. And out of that number, right now it is estimated that anywhere between 10 to 30 trillion will touch in some way, shape, or form this ESG type of investment. The problem is that most of the ratings that are given to the ESG ratings are coming from various rating providers, and they are not consistent necessarily. So text and data analysis and sentiment analysis actually is helping to ensure that the actions of the companies are actually consistent with the ratings given. So these are examples of classification and network and pattern recognition, which actually is given the power of the algorithms and given the available data, which is much more in these areas, they work relatively well. It's primarily for short-term investment strategies, but now they are starting to get used more and more for the medium and long-term strategies. network analysis and clustering is another area where it is quite useful, because the challenge in the industry is that it relies too much on the sort of the correlations, which are capturing just linear dependencies. And in many cases, you may have spurious correlations. And I have here some examples, including one somewhat famous example in the industry, where the population growth of the captive Asian elephants is explaining very well the cross-section of expected returns, which, okay, that essentially will say, well, this is actually a very good factor compared to the other factors which are used in the industry for factor-based investing. Whereas you can imagine that is not the case. And this is one example why just using correlations is not a great idea. And people are trying to enhance that by using network analysis and clustering. It's also the situation that in most cases, the correlations are going to be calculated as an average over a large period. And as soon as one gets to a different market regime or market state, then those correlations can change very significantly. What happened, for example, in 2007, 2008 crisis, the correlations went towards 1, most of them, or at least many of them. But then in other crisis periods, that may not happen necessarily. They may go in different directions. Like in this year, what one item that happened in the crisis in March, well, not crisis, but the March sort of problems in the market, were the correlation between equity and fixed income actually switches the sign. So what will happen is that in addition to that, the correlation lacks this notion of hierarchy, and that is where all things combined, all things put together, that is where clustering and network analysis can help a lot. So to give an idea, imagine that you have a portfolio which has 500 elements. Let's say, think about S&P 500 stocks, 500 stocks. If you want to create a portfolio and you are going to use just the correlation matrix or the covariance matrix, you are going to end up with a 500 by 500 matrix, which is difficult to estimate and is not robust in those different market regimes. If one was to use, let's say, clustering, one can cluster along the lines of, let's say, industries or sectors, and one may end up with 10 or 12 sectors or clusters, so to speak. And then one can simply choose, let's say, 3 or 4 stocks from each cluster, and will get a much smaller portfolio, yet which is going to be more robust, is going to have lower transaction costs. And one can go one step better and to add network analysis. Imagine that each of those clusters is a network, and then what happens is that the closer stock is to the center of the network, the more effect is going to have, the more influence is going to have over the other stocks in the network. So one can simply choose the 3 or 4 stocks from the cluster by choosing from the ones which are the closest to the periphery of the network rather than the center of the network. And there are some other examples how this clustering and network analysis can help. You have them here. I will go to the next topic in the interest of time, which next topic is going to be the forecasting of financial time series. And the problem here is that we don't have enough data for sort of the regular machine learning algorithms. And also we need to capture, those algorithms need to capture well enough the stylized features of the financial time series, something like volatility clustering, for example. And the difference between, let's say, machine learning algorithms and models such as stochastic volatility models or local stochastic volatility models or something along those lines is that machine learning algorithms can only capture the features which are available in the training data set, at least most of them, as opposed to, let's say, stochastic volatility models, which can do some not bad job even for the regions which are not necessarily captured well in the calibration data set. In most cases, well, machine learning algorithms cannot do that for time series. So what happens is also that the time series that we have available in the industry are primarily daily at most. So there was a competition about 2 years ago called M4 competition, which actually said we are going to take these 100,000 time series, most of them daily, some of them weekly, some of them intraday. And those time series came from various industries, including finance. And they asked the forecasting community across the world to give the best, sort of their best shot. They got about 65 entries. The regular, sort of the pure machine learning algorithms were ranked only 25 or lower. The best ones actually were ended up to be a combination of machine learning and non-machine learning, primarily statistical methods. And the best one was actually done by an engineer from Uber. The second best was done by a team at Monash University in Australia. And actually the top 5 were based on a combination of machine learning and statistical. For why that is, in principle, why that is better, because the on one hand, you have machine learning, which is capturing much better the nonlinearities in the data set, but then you have the short-term features, medium-term features, and long-term features for the financial time series. It appears that the machine learning is not capturing well the medium and long-term, so that's why the statistical methods are sort of there to help in that regard. Plus, they can capture other features which machine learning at this granularity cannot, and because it doesn't have enough data. So to give an example of such a combination, the second place of this competition was obtained by an algorithm that is relatively simple. It was simply a combination of regular 9 statistical methods that was applied to entire data set. By entire data set, I mean all time series that were given. And then they used the gradient boosting, especially XG boost, to find out what would be the optimal weight of the combination. And they got the second best place in this algorithm, in this competition. The pure machine learning algorithms, the machine learning community was not very happy to hear that, okay, they cannot do well for this type of data series. And the only good results actually ended up in articles that were published and codes that were available primarily in the last 12 months, because they had to create a specialized algorithm to deal with this. And I have here some examples. In particular, Quant is actually a very good forecasting time series library from Amazon, which is open source. And there are also a few other ones, including Telescope, which was just released this year. And another one was, it's later, actually, it's ended. Also, in the same time, you have quite good forecasting methods that are done by, which are not machine learning, primarily done by various people. In the ones that I'm familiar are in packages in R packages, like done by teams in the team in Australia at Monash University. For another example, another good package right now that you want to look at is this SK time, which is done by a team at Alan Turing National Institute of Artificial Intelligence in UK, which actually implemented the best methods that were done, that were presented for that M4 competition. For why this forecasting is quite important, because essentially, since we have medium and long-term forecasts, we need to medium and long-term investing. We actually need to have the sort of medium to long-term forecasting, and you are going to hear a lot about this empirical asset pricing, which is essentially forecasting for asset classes, for the returns of the asset classes. Now, here I will not go to this part. Reinforcement learning is something which is actually quite useful. It is used primarily in trading right now. It starts to be used in investment and wealth management. One example is about goals-based investing and machine learning. Goals-based investing is about essentially the client is saying, I want to have a portfolio which can give me, let's say, $100,000 a year in retirement 30 years from now, $70,000 per year for years, 10 years from now, let's say for 4 years for college education for the kids, and perhaps $50,000 in 4 years for a second vacation home. And these are financial goals. And then the investment professional has to create a portfolio which can give a probability of success above a certain threshold for each of those goals, given the priority level. And the good news is that reinforcement learning actually is using the reward function, and one can make a connection between the goals, the financial goals of the client, and the reward function. The connection is not straightforward, and there are some other challenges there. However, this appears to be a very interesting area. I will not talk about the market spacing regime. This is an extremely important topic, but I will not have time too much for it. One part about it I will discuss right now about a good application is about generating synthetic data. Primarily, and that is needed because of the few reasons I have on the slide. And what happens is that also right now, machine learning needs much more data than available to actually to be calibrated properly. And that is one area in which this data augmentation, this is one area where machine learning is starting to be quite useful. It was applied primarily for trading type of data by people at JP Morgan and Standard Chartered. And it has some good results, not great, but good results, because the main challenge is how to actually, one needs to ensure that the data which is obtained that way is actually valid, which means it has certain characteristics which are deemed to be important. And this is becoming very important also for investment and wealth management, because the main problem with the portfolios, with the investment strategies, is that one needs to show that they are going to work not only in the past, but also in the future, in the near future. And for that, one cannot simply use backtesting based on historical data. That is a necessary condition, but it's not sufficient. So data augmentation is extremely useful to actually provide much more data such that investment strategies and portfolios can be tested better, can be analyzed better, and eventually, which will be, I suppose, in 2 or 3 years, which is actually one of my projects, eventually one can do portfolio optimization, which is scenario-based. So scenario-based portfolio optimization to actually make the portfolio to be much more robust compared to what is currently there. Factor-based investing is also important, but I will not have time to talk about it. Right now, the parts which are becoming definitely interesting, well, let me talk about the practical challenges. So we have situations right now where machine learning in principle is well, everybody heard that it can be quite useful. The problem is that, well, it doesn't work very well just out of the box applications, plus there are these challenges which are due to data, due to regulations, due to lack of explainability, due to tuning of the hyperparameters, and even the fact that you actually want to have training data sets which are covering the most relevant features of the time series. So I will be able to talk only about 2 areas here. One of them is actually there is a need to incorporate causality in machine learning. This is still a very big sort of work in progress. I have seen I have seen a lot of projects here. They are still not very good answers yet, but there is a lot of progress, and this is one area that is becoming extremely important, especially because it is connected to the explainability issue. Right now, people are using explainability and interpretability much more interchangeably than it should. And most of the time, I have seen results and libraries that are dealing with interpretability rather than explainability. However, both senior management and the regulators are asking primarily for explainability. Interpretability is also needed. It's those packages that I'm mentioning here are actually useful there, but it's not enough. And I have here some examples. The best ones I have found as of now is not Lime, for example, which is quite used but has issues that I'm mentioning here. But it's essentially there are these two packages or frameworks of packages, one from Microsoft and one from a Polish company. So for finally the last part will be about automating machine learning, tuning hyperparameters. So right now, at least for the time series that I have seen, it's for investment and wealth management, and in general, actually, it doesn't work well because, well, it doesn't work very well, I should say. There are situations where it does work, but it's much less than what the automating machine learning community or companies are saying, primarily because it's a challenge with essentially with the optimization algorithms that they have there. However, these are some better ones that I have found, and there are some this year actually they are starting to be better or much better compared to last year. It's still not good enough from my perspective, but there is good progress there. And yes, and now I'm done with the presentation, so I can have one or more questions.
Thank you, Christian. Let's thank our speaker. We may have one quick question, perhaps. I've got, could you, in thinking about all the various problems of investment banking, could you pick one area that you think in the short or medium term machine learning will be the most useful?
Well, essentially two of them are going to, well, actually three of them. Is going to be scenario generation, rate augmentation. The other one is going to be application of reinforcement learning. And the third one is going to be, has to be this forecasting of time series. Now, so these are essentially the most important ones right now. And those are the ones that machine learning is going to help. To which extent is not yet clear, but it's going to help.
Okay, I think it's time for me to pass over to Professor Zhu, who will introduce our next speaker.
Can I ask one question before?
Yeah,
sure. Yes.
I mean, we also see a lot of papers in the literature about solving high-dimensional PDEs using machine learning.
Yes.
Do you come up with those in practice?
The PDEs are much more useful on the trading side when for solving for pricing and hedging financial derivatives. And yes, they are there. In that area, to be honest, so I see more. However, the much more promising solution there is based on symbolic regression. In fact, symbolic regression may become even bigger compared to machine learning right now. Okay. I mean, in the near future. So on the investment and wealth management, we don't use almost at all PDEs. We don't use stochastic calculus. It's that is primarily done for for trading and for short-term investment strategies and for pricing financial derivatives.
Okay, thank you.
And one final thing to say, so feel free to ask me questions after and also by email, and we can have other discussions if necessary. And I'm back.
Oh, okay. So let me try to introduce the next speaker, Nick Constantino. I hope you are here, Nick. And so Nick and I met first time like in 2015, I think at a conference in Michigan State University in East Lansing, Michigan. And so Nick got his PhD in partial differential equations, I believe, like at Brown University in 2006. And then he worked in many financial institutions, including Bank of Montreal and the Scotia Bank in Canada, and then like AIG, Nomura, and Barclays, in New York. And I believe that Nick will join like a Citibank very soon. And so, I mean, the weather is very nice here today in Tallahassee, and it's too bad that you cannot be here because of the pandemic, but I hope I will see you again in the future, in person one day. So Nick, okay, I see. Like, do you want to share your screen with us? Or?
Sure. Yeah. Thanks for the invitation. So let me share the screen here. Yeah, thank you a lot for the invitation here. And so my what I'm going to talk about is a very, very small subsample of the kinds of things that you can all see my screen, right? Yeah. The kinds of things that Christian was talking about. Christian had a very large scope. And one of the things that he mentioned is that, you know, machine learning hasn't been that successful in some sort of forecasting.
Nick, I don't think we see your screen yet.
Or you can't. Okay. So maybe that's why.
There you go. Thanks.
Okay. Except now that it's there we go. All right. Thanks. So yeah, so Christian gave a very broad overview of you know, different types of machine learning and finance. I'm going to zero in on one particular one, which is forecasting, and you know, how useful is that, and what are the successes and failures. And one of the things he mentioned is that, you know, it hasn't been there isn't that much outperformance yet using machine learning versus traditional methods, statistical methods. And so I wanted to focus in on that and kind of understand a little bit about why that happens, right? So using some very, very simple ideas, focus in on the general picture of finance, which you have a lot of noise, maybe not as much data as you'd like. We'll talk about exactly, you know, how much data we mean by not that much. And using very simple examples, kind of trying to elucidate what are some of the pitfalls and difficulties that machine learning has in being useful for investment strategies. So that's the main goal. So basically, yeah, I just want to outline the slides here, or outline the presentation, and the basic ideas are going to motivate what's going on right now in terms of investing and using machine learning, and we'll see that it hasn't been that successful, right? And I'll give some examples of that, and then we're going to just focus on why it hasn't been that successful, right? What's the main things? And the way to do this, I think, is because you know, one of the problems that finance has is that it's, you know, there's no reproducibility. I only have one realization of the S&P 500. How do I do some science on that? So one way to do this is actually do a simulation study. We have a process, we know what the process is, and we generate some data and look at I'm going to pick two different methods, a neural network and linear regression, and kind of see what happens as I change the amount of noise, as I change the amount of observations. What kind of happens? Is there, you know, regimes where machine learning, actually neural nets, does a much better job? And that's what we're going to look at, right? And then maybe some applications at the very end. Okay, so why is there a push in machine learning? So in finance, there's a lot of discussion these days, and you see that everywhere, and you saw that with Christian's slides as well. And the reason why is because it's been very successful in other fields, right? So Facebook has you know, had deepfakes, and it has an automated algorithm that achieves an accuracy rate of the same as humans, right? And it does it much faster, 97%. That's fantastic. So, you know, Facebook has done something in that field. Microsoft too, with speech recognition, you see it on your phone where it transcribes your calls, right? And it does it at a rate that is less mistakes than humans, right? And it does it faster. So there's an amazing, you know, breakthrough. And okay, so for Microsoft, Google AI does AlphaGo, right? It beat AlphaGo champion. It also beat chess champion. And by the way, these algorithms here, they are not just learning, they're not just copying all the different types of potential moves and then, you know, just optimizing that. They're really just learning. They're learning the games and through adversarial networks. So this is a great breakthrough, right, for them. Great breakthrough for Google Health, where they actually can, you know, detect cancers. And so you might say, look, all these other fields here, AI, machine learning, all these different methods are actually doing a great job, better job than humans. Can we actually, you know, do this in the financial institution, right? You have these discretionary traders who are making decisions, and they make a decision, based on their own learning, and they do it in a certain way. And maybe there's a way to automate this. You automate this, and you get these decisions, through a machine, right? And so that's what the drive has been, right? And we try to have these same successes that you had in these other fields in finance, right? And as an example, let's look at Refinitiv. Refinitiv is an old Thomson Reuters business. They do a survey every year, and I think this is the year 2020. They found that roughly 72% of the respondents, they did a survey of a bunch of financial institutions and said, hey, how important is machine learning and AI to you? And they have a whole bunch of, they separate things buy side, sell side, and so there's different statistics for all these things. They're very comprehensive. You can look it up online. And they do this every year. They do this for the last maybe 5 years or something like that. And one of the big things is that, I've seen this over the years. Now, as of 2020, 72% of those financial institutions say that, machine learning is a core component of their business. That's a lot. It started out with, I can't remember the number, but it's grown a lot, right? And a big one is that 80% of these guys are making significant investments in the technology. So it's a big thing. There's a lot of investment in people and time, technologies. Okay, and third one, which is an interesting thing, is that 32% are saying they're using for portfolio management. So there's a buy side and sell side firms. So there's a lot of investment in here, right? And let me go down. So the question is it worth the investment? Is it worth the investment in time and effort? And well, you think that it should be, right? Because it's not linear, it's a better technique, it's all this other thing. But here's an example of maybe where it isn't. So this is not a statistical example, it's actually a financial example. There's an index, the Eureka Hedge AI Hedge Fund Index, and the Eureka Hedge basically has a bunch of different indices. One of them tracks the performance of all hedge funds, different kind of hedge funds, macro, these kind of commodity CTAs, whatever. And one of them is what they would call AI hedge funds. So these are hedge funds that at least proclaim to use significant amount of new technologies like machine learning and AI in their funds. If you look at the actual returns, it basically tracks the Dow Jones. So the Dow Jones is the red line. You could pick the S&P, would be very similar. And that's so a passive investor, this is only 10 years of data, and you can, slice it up in different ways to get something fairly similar. But the basic idea is that, over the last 10 years, a passive investor that just put money in Dow Jones received roughly the same returns as the average. This is a equally weighted average index, the equally weighted average index of these AI hedge funds, right? So it hasn't, on a financial level, been performing as well. And there's other indices and there's other things we can go a little deeper, but the performance of the traditional asset managers has not been any worse than these newer funds. Okay, so this is one of the things. So the question is, why is this? Why is this happening? What's the difficulty? Let's say you are a long only or long short fund who invests in stocks in the stock market. You're trying to do a lot of forecasting. And you heard, Christian mention that forecasting is a very difficult endeavor for a lot of reasons, a lot of noise, a lot of lack of data. What else? What are the real reasons? Well, one of them is that you don't typically have stationarity in these time series. So AQR, which is a large asset manager, had a white paper and said, well, in other fields, when you do learning, things don't change. You don't learn something's a cat and all of a sudden it changes into a dog. And that's sort of what's happening in the financial markets. The signal sort of disappears or changes. And once you learn it, there's a lot of non-stationarity. Okay, so that's one of the problems. The other problem is that the data is very, very noisy, and it's by nature. By nature, the signal has to be weak, proper functioning of markets. Whether or not you think of the noisy market hypothesis or the efficient market hypothesis, basic idea is that there has to be a lot of noise, or else things aren't functioning pretty properly. There has to be a lot. These anomalies should be short-lived, right? And that's where there's very noisy data, very little signal in the data. Okay, and that's hopefully machine learning can pick up, and we'll do an example. Neural nets can pick this up. But if you have limited amount of data, then you might ask yourself, could you actually really pick up this extra amount of signal that you have in the financial time series? And finance is actually a small data issue, right? And everyone talks about big data, but in finance, maybe there's big data in terms of the overlying cross asset amounts of assets there are. But in terms of every particular one asset there's not that much data. If you look at daily time series, you're looking at basically 250 observations if you're looking at daily per year. And so 10 years, it gives you something like a small number of data points, right? Like 5,000. Okay, so or 20 years gives you 5,000. So the point then being that you don't have that much data. So intraday data gives you a lot more, of course, and maybe that's where the application is. In fact, that's where the application is. But you also have weak nonlinearity when you actually look at underlying factors in the if you are able to deduce a factor and you actually see if it's nonlinear. Well, it turns out that you don't have that much nonlinearity. Okay. The other difficulty is actually the implementation, and we'll go through the implementation in a second. But there's a lot of hyperparameters to look at, and it makes things a little bit trickier than just traditional sort of statistical methods. Okay, so what we're going to do is just a very, very simple simulation study, and see how changing the amount of data used in training and the amount of noise in the actual data set affects whether or not neural nets, when I say machine learning, really in this example, it's going to be neural nets, is useful or not. So that's and where the boundary crosses, how much I really need to be useful. So what I'm going to do is I'm going to describe the simulation study, right? Then try to present some results. And at the end of the day, hopefully get some rules of thumb of when it's going to outperform, when it's not going to outperform. Now, this is a simulation of a very, very simple, data generating process. So the reality is going to be much more complicated than this, but should give you a little bit rule of thumb. Okay. And I want to describe some strategies where it might work. Okay. So here are the results that we'll look at. And basically the idea is that when you have very little data, and this is pretty intuitive, your linear regression is going to outperform neural nets, right? And the idea is that you don't have enough data to kind of learn the nonlinearity or learn all the other nonlinear things, right? And then eventually, once you have enough data, and enough, I should put in quotations, it depends on the noise, but once you have enough data, and then machine learning does outperform linear regression, okay? And so the exact amount of data needed to outperform linear regression depends on the signal to noise ratio. And what happens in financial markets is signal to noise ratio is really, really low, which means that the amount of data you need is very, very high. Okay, and that's what's really going on here. So the other thing is in the simulation, I'm doing many experiments and averaging them. But of course, so I'm doing many experiments and averaging the performance, but the variation of performance can be quite large, especially when you have large noise. And so on any particular realization, there could be interchanging of the different performance. So it's very noisy. Even the performance is noisy. There's an average performance, there's a variation of the performance, and variation performance is noisy. And the other one is that if I change the process a little bit and make it non-stationary, then linear regression is still more stable. So I'll make that a little bit clearer as we go on. But this is basic idea is that there's a lot of noise in financial markets and very little data, and that makes it very hard to actually forecast well with other methods other than linear regression, and this is the reason why. So here's just a simulation study very quickly, is how I'll describe how this works. So before even just looking at a simulation study, let's just look at something very, very simple, right? I'm abusing notation here by making this a time series when really this is cross-sectional, but I'm just trying to motivate how things look when you have a lot of noise. So I'm going to take a normally distributed random variable and make it nonlinear by cubing it, right? And if there's no noise, I get this figure on the top right, top left. Everything looks nice and cubic, exactly what you would expect, right? And there's Right. Now let me add a little bit of noise to this, right? Let me change with the sigma epsilon. And I can see, I still see a bit of a pattern, right? I still see a pattern that is cubic, but it's less, right? And as I add the noise, once I even when the sigma epsilon is 20, I'm already sort of removing it. I can't see, at least visually, that there's a cubic in there, and eventually I just get, you know, noise. So as you can see, that even if when you have a lot of noise in your process, even if there's an underlying signal, underlying pattern, it's very hard to see, and you can imagine that it's very difficult for neural nets, in this example, to pick that up. So just to make, before going into more details, just to make this more clear. So if I have something nice in cubic and I put a line through it, you can see that the R squared, and you'll see this wrong model. It's a misspecification of the model, and you would say, look, the residuals tell you this is the wrong model, but nevertheless, you do get, you know, an R squared of 60%. And if I fit the cubic in there, I get a perfect R squared, of course, right? But again, now let's do the same thing when I have some noise. Well, the R squared goes down for the linear fit. The slope is still the same. The right fit is really dependent on the signal. The slope is still the same. But the R squared, when I have the exact model, cubic model, still goes down drastically, right? It's just the underperformance, lack of performance, is really due to the noise and not the misspecification of the model. And that's sort of what's going to happen. As I add more and more noise, there's going to be very low R squared, and it's all going, whether I have the right fit or not the right fit, the basic idea is that all the error is going to be in the noise rather than the misspecification of the model. Yeah, the fact that I have a well-specified model doesn't really matter that much. Okay, so how are we going to do this? We're going to do a simulation study. What I'm going to do is this model that I described to you up here, this cubic process. I'm going to simulate it. I'm going to fix the amount of signal, which is sigma x, and fix the amount of noise, and then generate 5,000 observations. Why 5,000? As we discussed, about 20 years of daily data. Okay, so you have 20 years of daily data, and then I'm going to split this up. I'm going to put 500 of those observations for out of sample testing, and then train on the rest. Now I'm going to train it on different sizes of data, right? I'm going to train it on 250 points and do an out of sample of 500. Train on 500 points, do an out of sample test, train on 750, do an out of sample. Okay. When I train it, I'm going to train two different models. One is just a neural net model, and one is linear regression. Okay. And once I've trained it on the different sizes, and I'm going to check the out of sample performance and record them. So I'm going to have, you know, a bunch of out of sample R squareds for the different data sizes. Okay, and then I'm just going to repeat it 100 times to get some good statistics of R squared, right? Because I want averages, and then I'm going to repeat this for different levels of noise, and I want to see the behavior as I change noise. That's the real thing. When things are very noisy, what really happens? If you notice in all these other examples given by Google Health or classification of dogs and cats, there wasn't very much noise in there. You really had a full signal, and you trained on that signal. In finance, you have a lot of noise, and that's exactly what we're going to try to discuss here, right? Okay, so just schematically, this is what's going on. I simulate it. That's the green line here. I simulate data. I hold 500 points, and then I take 250 to train on, and I forecast and calculate the out of sample. Take 500 points, forecast, calculate an out of sample. Okay, and I do this for different types of noises. Okay, and the two different models that I'm gonna. So once I simulated the data, the two different models I'm going to apply to the data. One's just a simple neural net, and the other one's simple linear regression. I have to estimate two parameters for the linear regression, the A hat and B hat, and I have to estimate multiple parameters for the neural net. I'm using grid search, so I optimize a bunch of the hyperparameters, and we can discuss how the optimization goes too. And I optimize the learning rate. I optimize a lot of the different hyperparameters. Okay, so that leads to not. I mean, as I'm changing the data size, you can say I'm overfitting or underfitting. If I fix the architecture, I'm not fixing the architecture. Okay, so All right, so this is what I'm going to do. That's the basic study, right? And if there's any questions, please, go ahead and ask, right? But that's the basic study. Now, because I have a very, because I have this process here, way up here, this cubic process, I can actually say something about averages, and that's what I'm going to do here. This is just a rule of thumb, right? I can give, let me actually give some results on the signal to noise ratio. The signal to noise ratio obviously goes down. This is the first formula here. It goes down as I have more noise, right? The maximum R square you can get on average also goes down with the amount of noise. So you can see when there's no noise, the maximum R squared I should be able to get is 1, and not with, I mean, if I have the true model is 1, and as I add more noise, I eventually, the noise will dominate, and I can't get much of an R squared anyways. This is the coefficient of the linear regression. It's just 12. Okay, it doesn't matter. But of course, on average, the R squared for the linear regression will be roughly about 60% of the maximum R squared. Okay, so when I fit a straight line through the cubic, whether there's noise or not noise, I'm roughly only going to get about 60% of this. Okay, so what does this look like in pictures? Is this little picture here? The blue line is what the linear fit will give us as an R squared as a function of noise, and the gray line is the maximum amount of R squared I should be able to capture with the perfect model. Okay, this is again averages with infinite amount of data. So there's two things that are going to go on. One, we're not going to have infinite amount of data, so there's going to be some noise around these two lines, right? Because I'm doing a finite sample. This is an infinite sample, is a way to think about this. And the other thing to think about is that typically we are way in the right-hand, finance is way down in the right-hand side of the screen, where you have lots and lots of noise. And so on average, there's not going to be that much difference between the linear regression and the asymptotic, the amount of R squared you can capture. It's still 2/3 of it. The linear regression only captures 2/3 of it on average. But the other thing is, because you're way down on this noise level, the variance of your performance is massive. When you actually simulate and you do one or every realization of that simulation, the variance is so much larger than the average, and so that's where you get a lot of these. That's why you have noisy results. When Christian was mentioning that this the M4 competition, and there were some great results on that, but the average the typical performance of any other machine learning technique was very low, and that was written up by, I think his name was Spiros Makritadis recently. So, and this is the reason why you only have one realization and you have a lot of different a lot of variation here. So now let's give you two examples of the results here as a function of number of observations. So let's focus on the left chart. What the left chart is exactly that procedure I mentioned above, where I simulate 5,000 observations, right? And then I do a out of sample performance using a specific number of data points, right? Observations. So here, for very low number of observations, when I train with 250 points, I notice that actually linear regression does just a tiny bit better, and machine learning didn't quite train yet, but very quickly, I don't think this number is 500. Very quickly, it kind of picks up when there's no noise, right? Remember, sigma epsilon equals 0 means there's no noise. It's a perfect cubic. When it's a perfect cubic, very quickly, the neural net picks up that it's a cubic. And I can give you the architecture. I think I just used up to 60 nodes, so it can't be exactly a cubic because the basis function was these rectified linear functions. It can't get exactly one because it can't replicate cubic exactly with these rectified with the basis. But it very quickly gets that it's a cubic. It's done. So it very quickly fits it nicely, and linear regression puts a line through it. We're done, and there's a massive performance difference when there's no noise, right? Okay, so let's do another example where and of course this picture here, I didn't just do it once. I simulated that data. I did this procedure about 100 times and averaged it. So this line is an average of 100 different realizations of that process. Okay. Now let's look at adding noise to this. So when I add a bit of noise, and then I get something very similar, but there's a crossover point where early on, right? So the blue line is my regression line, where I did a linear regression on this on a certain number of observations and forecasts, and that was my R squared, the average R squared. And again, I took a certain number of observations and I forecast, and I get an R squared, and it doesn't change that much with the number of observations, right? Once I started at 250 and I incremented by 250, because that's 250 data points, observations, roughly a year of daily data. What I noticed, it doesn't really change much. This is a little bit of noise here because I'm only taking 100 average of 100. If I did much more, the curve would be smoother, right? But now I look at the machine learning, right? The neural net. If I only have 250 data points, it underperforms a linear regression. And it takes a little bit of data before it overperforms, right? It underperforms until about 1,250 points. Right, and then it crosses over somewhere in between, and now it performs, and now it gets almost the maximal R squared. The maximal R squared in this case was, I don't think 52% or something like that, and it gets almost all of it. It does get almost all of it, right? Whereas the regression line doesn't get all of it. It gets about 3/5 of it as predicted. But the bottom line is that it took a little bit of time for this to happen, right? Okay, so now let me actually do this thing here. Instead of giving you graphs, let me plot for every single noise level. Let me plot where that crossover happens. Notice that the crossover happens very quickly. What I mean by crossover is when machine learning, the neural net performance overtakes the linear regression performance. And it happens very quickly when there's no noise. It happens a little slower when there is noise, right? When there is noise, the neural net outperforms the regression line a little later. And so, and I put a little caveat, we're looking at statistical performance, and that doesn't necessarily imply financial performance, but you know, it's indicative, okay? So let me actually do that chart. So the next chart is exactly this. It's the crossover. This is each point that you see on the top left is the number of data points, that's the number of observations for which is needed, right, for machine learning or the neural net to outperform the regression line. That's it. And it depends on the amount of noise. As you saw, if I have no noise, then very quickly the net picks up that it's a cubic, and very quickly I understand and beat the forecast from linear regression. But as I add more noise, as I go further along here, then I actually need a lot more observations for me to actually beat the linear regression line for the neural net to understand that there's actually a signal in there. It needs a lot more observations, but eventually it does pick that up, and it does outperform, but it takes a lot more, right? So it's way over here. And the reason why this is interesting is because think about what this means in terms of how much daily data I need. 50 years of daily data, of perfectly stationary daily data, and then eventually my neural net will beat my simple putting a simple straight line on it. Okay, and if I do this as a function of the maximal R squared, right? Because every noise level corresponds to a maximal R squared by one of those formulas. I get that. Well, when I have very low R squared, very low signal to noise ratio, I expect large number of data points. I need a large number of observations before I can learn, my net can learn the nonlinearity and outperform a simple linear regression. So that's the key takeaway. So the key takeaway in all of this, basically in this slide, is that if your data is very noisy, it just takes you a lot of observations. This is something that Christian mentioned, and I just wanted to do a simple example with a very simple data set of why and how that happens and why that happens. And so in the typical financial applications where your signal to noise is very, very low, you would expect not, and you're using daily data to do something, you'd not expect any outperformance. So the real applications, if you're doing forecasting or in tick data, which is intraday data, And there you get millions of observations, and that actually works. So all hope isn't lost. If you want to not use tick data, not use forecasting, you want to use daily, things like that. Well, there's a lot of different places that machine learning can be useful. This is a very, very small subset compared to what Christian had, but two big ones are classification. You can use classification to outperform markets, and just direct asking when will the signal go up, or when will the market go up and when will it go down. That's a lot less to ask than what exactly is the price of a security. Okay, and the other one that looks promising, and there's a lot of really good examples and results, is of using reinforcement learning. That's hedging equity portfolios is one of them, and in market making. This example was in corporate bonds, but the market making in general, there's a great amount of success in using reinforcement learning in market making. Okay, so yeah, so basically just wanted to explain why forecasting with neural nets has been problematic, just by giving you a simple little example, and hopefully that elucidates with that small point. Thank you.
Oh, thanks, Nick, for an excellent talk. And this is really interesting talk. So like I see like we have like two questions from the audience, but before I ask you the question from the audience, may I ask you a question? So like in your talk, I suppose like one of the takeaway is that like if you have like sufficient data, and then like machine learning, like a neural network might outperform linear regression. But I'm wondering, like, let's say in what type of like financial applications you don't have enough data, and for what type of financial application actually you expect you will have enough data, so machine learning, it becomes like a promising usually.
Intraday data. So if you're looking at patterns, I mean, one interesting application is there's a lot of volume. So, you know, I was talking about efficient markets, but sometimes markets have rules. And one of the rules is that there's the mutual funds and a lot of these closed-end funds at the end of the day need to mark their books. So there's a lot of inflows at the end of the day, right? A lot of volume at this. That's why you see the volume at you know, from 3:30 to 4, and that's so intraday. So sometimes there's things that happen in the day that are much better. First of all, the non-stationary that happens in the day is much less than non-stationary that happens, you know, over years, right? And then intraday, you have things at the nanosecond level. I think Thomson routers and other things, you know, give you microsecond level. So now we're talking about millions of points per day. And now you can do something. And so these people, and the market makers too, the market makers are doing that at that level. And that's why you actually can do some good things with it. And reinforcement learning, or even forecasting, you can forecast at the microsecond level. It's a little easier to forecast. I can tell you what's going to happen 1 microsecond from now, but days from now, months from now, it's a lot harder.
Okay, I have a question from Shu Bo. He was asking like which machine learning package is being used the most like for implementation, like maybe in practice versus like academic research.
I mean, that's a big question because it really depends on the application. I mean, this thing here didn't have a real time series component, so I just use a ANN, right? Neural net. But recurrent neural nets are something very, very big for when people do this kind of thing, or LTSM. LTSM is something that people use too. Again, there's maybe a next slide, next talk. There's problems with LTSM because it just basically does it one day ahead, 1 day behind lag. But anyways, that's very popular. So if you wanna brush up on things, recurrent neural nets, LTSM, this kind of stuff is probably.
And there's another question from him, and he was asking like, for your particular neural network model, like how many hidden layers do you use, and what activation function?
Yeah. So I did this particular one. I made it very simple. It's just one layer, and the I think up to 16 nodes. And then the activation function was rectified linear. Yeah. To be honest with you, actually the grid search, so I did a massive grid search. I actually allowed it to choose between linear and rectified linear. And that's the point. The point is that, you can also see why it doesn't learn, because it doesn't actually pick rectified linear it actually picks linear when you have small amount of data. The basis function ends up being linear. So you can actually tell just from the basis function that it chose, right? Because I do a massive grid search. What do I search over? I search over the basis functions. I search over the the amount of nodes, the actual architecture. There's another example of this where I add in a fake variable. So this is just single variable, but I add in a fake variable. So I have two variables and I have multiple layers, 3 layers, and it gets even worse. It's even more complicated. So I'm giving you the best case scenario here is that it takes a lot of data, but in reality, it takes a lot more.
Okay, thank you. I think like we are running out of time, so I will turn to Girai, who's going to introduce the next speaker. But thanks, Nick, again.
Thank you.
Thanks a lot for excellent talk.
Thank you, Ling, and Nick. Thank you for the talk. Excellent talk. I'm happy to introduce our next speaker, Stephen Pennington. Stephen is the founder and the lead quant at Stephen Pennington Analytics and Advisory. Prior to this, Stephen was the managing director of quantitative analytics at Amherst Insight Labs for several years. Steve's experience has centered around the design, development, and application of tools for analyzing and valuing structured financial securities. And Stephen is an FSU, was an FSU student. He earned his bachelor's degrees in economics and mathematics in 1998. And then he received his master's degree from our financial math program in 2001. Stephen, I'm muting myself, and then you can share your screen.
Can you guys all see my screen now?
Yes.
Okay. So, good morning. My name is Steve Pennington. I am perhaps I'm a quantitative developer in an area that has a very rich tradition of quantitative development. You see mortgage-backed securities models going back to the late 80s. Some of the first models in this space were from gentlemen like Kazarian and Laurie Goodman. So this is a rich area, but today I'm going to start with just one problem. And what sounds like a very simple problem is actually one of the hardest first problems that you're going to deal with as you move forward. So where we're trying to go here is we're trying to price complex mortgage-backed securities or complex structured securities that have embedded financial derivatives either through the assets or directly as part of swaps of interest rates or transformations of cash flows. So historically, where there has been a lot of work done in this space with the BGM model, I think most of you guys have probably seen at least some exposure. I call it the LIBOR market model. There was a lot of work in 04 and 04-02 with Brace and Musiala, and then fitting the curve through Revenato. The problem is that requires two pieces that I'm going to talk about that are in massive flux. So we had the LIBOR fixing scandal in 2012, and basically that prompted a lot of, from the Bank of England and the Federal Reserve, a move away from LIBOR. At first, I think people were oppositional. It looks like that's going to be occurring. Two impacts of that are going to be, number one, you'll have less trading. You'll have LIBOR that's no longer the same form. Number two, you won't have derivatives, i.e. swaps, caps, floors, swaptions on LIBOR. There's already been moves towards SOFR, it's the overnight rate provided by the Federal Reserve. So that's one thing. The other thing is that the pandemic has really brought an interesting perspective to what's happened. So this is Fred, the Federal Reserve, St. Louis Federal Reserve data site, and they provide massive amounts of data. I think there's 500,000 series. I strongly advise you to look at it. So what you notice is that the swaps data, and this is the swap 30-year, has provided inconsistent pricing from ICE, and in fact, from what was roughly the 21st of February through May 26th, there was no 30-year swap. So, and that's similar for other short-term swaps. So how do you build a model if you don't have a long-term curve? You don't have the long-term curve. That's an issue. And then the other issue is that the LIBOR curve is really a AA financial institution is who you're lending to. So it's not truly a riskless institution. So that creates a complexity of where do we go from now if I don't, number one, have the data, and number two, it's not even really an applicable approach to pricing mortgage-backed securities. So one option here is to then use U.S. Treasury or the Treasury curve of your location to then price the security in which your securities are domiciled, to then derive a discount curve and ultimately derive a simulation framework. We're just going to talk about methods for calculating a discount curve is all we're going to do, and then see how well that holds up. So here, I'll go over a bond math reminder. I'll go over the curve fitting options, and then I'll go through an actual real world case, which is starting from bond prices. How do I get to actual discount curves? And then once I have a discount curve, how well does that discount curve perform? And how does it perform versus notes and bonds? With all of that, I'll then have a discussion of next steps, which is what do we do to improve this? How can we improve it? And then I'll have some closing remarks on why does all this matter? And finally, some notes on the bibliography. So let's jump into it. So I'm going to go through this quickly. I'm going to assume all of you guys have had some extensive exposure to this. But what we're going to work in is continuous time finance. And we're going to talk about first continuous yields and then continuous calculation of forwards. And then in R3, you'll see the representation of the continuous yield as the average, or the integration of the average forwards over some time, capital T, the term, to small t, your initialization. And what we're going to ultimately do is we're going to talk about coupon bonds as a series of payments, constant payments in the first statement, C, that pays then principal at some final term, TN. And then we're going to talk about developing the discounts factors, the PT, T sub I. Similarly, this will then apply to floating rate securities where the coupons actually change based on an underlying rate. One key thing here is I do want to differentiate is we're not going to work in a constant time yield. And I'm going to talk to you about why. So in a constant time yield here, the yield is constant across instruments. And even though when you take your derivative, you get the Macaulay duration, which everybody uses, that has a couple of shortcomings that I want to apply. Number one, different bonds and different coupons at the same time have different discount factors. And at different times, the same bonds discount at the same rate yield. And then the other thing is that when you calculate the Macaulay duration, it assumes that the actual coupon or the payments of the underlying security you're valuing don't change. That is incredibly wrong. And if you were to look now at most corporate bonds after 6 to 10 years actually have the ability to then pay you full principal and stop paying you coupon, so they can call the bond. So for a long time, people were like, oh, that's not going to be very common. They're all bullets. But in fact, that's changed significantly. And in the mortgage-backed securities world or the structured credit world, not only are those bonds subject to amortization of the underlying loans or mortgages, they're actually callable by the underlying individuals to which the assets were lent to. So that's a major issue, because ultimately people refinance or put back principal to you in times when rates fall and you least want to see the rates a reduced yield. So ultimately that leads to calculating yields that are dependent on time, but to calculate or to recover duration and a convexity, you basically take the derivative with respect to some parallel shift in the underlying zero coupon curve. And you get something very similar to the delta and gamma, and it results a nice Taylor series approximation to the change in price, the percentage change in price. So with that said, what are our options? So we've already talked about the BGM framework or the LFM. That uses a bootstrap, and it bootstraps the underlying LIBOR and then the swaps curve, and then use it in certain cases, uses the Eurodollar futures in the medium term. So you can bootstrap, and in this case, if we're going to use U.S. Treasury securities, we would bootstrap the zero curve and notes and bills, the payments off notes and bills, and bootstrap that. So that's an option. It is an involved conversation. And then there's splines to fit the data, and you can either use cubic splines or you can use splines that are fitting, that use some kind of fitting control, which we'll talk about, and that's what I'll actually implement. Smoothing splines. And then there's also parametric fits, where you use a limited number of parametric fits. You assume continuous compounding. You see these, and they use 5 or 7 terms. You see these pretty consistently, because this is what these are the forms that the Nelson Siegel and the Svensson methods take, and you see them consistently from the ECB and other large governmental banks. And the last is the PCA. It has a different data requirement, and so you have to have time series data and ultimately correlations of the different instruments, and then you can use the leading eigenvalues as estimates of shape. Problem is, it's not responsive to time change. And one of the key things that will happen to you is that you're going to be asked to update changing discount curves in response to changing economic environment, and you have to do it in a reasonable amount of time. So those are your 4 options. We're going to go with 2, a specialization of 2, where it's actually a power of 2 is the spline, and it's smoothing, so it's not cubic, but still you get a good fit. So here's a data review, and this is where we're starting from essentially scratch. And so we've got U.S. Treasury bonds. There's actually 563 here across notes, bills, and bonds. But we also have strips. So here I've done actually a breakdown of the different types of securities included in this 563 bonds, and those in the excluded variable, which you see is actually, I have a process for actually using the bootstrap. And this is when it's false, it's been excluded false, it's included in the bootstrap. And so that's one process that I've worked through. But we're actually going to today talk about Lorimer's method. And this estimates a continuous yield curve using zero coupon bonds. In our case, we're going to use treasury bills, and then we're going to use principal strips for the longer dated maturities. In this case, the smoothing spline, we seek to combine a good data fit with curve regularity, and ultimately a least squares criterion where we want to minimize over some time period, series of time periods T, the difference between the prices, the zero prices, and ultimately the payments, and some discount curve with respect to T. The key thing here when we move forward with this is that we need zero coupon bonds. And so not all 563 actually aren't zero coupon bonds. The only ones that are actually zero coupon bonds are the bills and the stripped principal payments. And what you can ultimately, so that'll be one of the exclusion criteria. And so what we're trying to do is for the continuous forward curve, given yields at some time I and time I, and multiplied times at that same time, I'm trying to find the function that minimizes this particular error term. So you can see that it's just the integral over some time ti f plus some error over some alpha. Alpha is a fitting criteria, and ti yi. And basically this is based on the continuous time comparison, or the equivalence between in continuous time between the integral of the forward curve over some time, and for that time t times that same yield. Ultimately, the goals are, as we've talked about, to minimize the error and smoothness criterion, which is the first derivative of your provided function. The function that meets this criteria is actually the elements, or the betas in it, are actually solved through this equation. So A is a matrix, F naught are your initial values, and then here I've outlined the betas, and then here's the ZI. It's just your alpha times your yield at time 1, yield at time 2, time 2. And this is ultimately the form of the matrix, where these are the integrals of HI, HJ over the time, the maximum of the time, or excuse me, the minimum of the time, TI and T2, plus T1, T2. So with that, these are the definitions of H prime and the condition of H0. With that, you get to a form that looks like this, which is very nice and very usable. So moving forward with that, I've actually done some additional analysis to cut down the set of securities. So first of all, I said, hey, I just want to look at the strips and the zeros. But as we noted before, stripped interests are actually securities that pay the strips of the coupons. So there's multiple cash flows. So they're not true zeros. Well, these bottom two are. Leaves us with 134 securities. But one of the things, and it's one of the things I like about this method, but it's one of the things to be aware of is that you can actually support negative yields. And there is actually one negative yield in this case. So I exclude it down to a group of 133. The other point here is I can't have repeated observations of yield at the same time. So here's a graph And then here's the reduction set. And so this is, yes, we're missing this particular set of data. And this is actually a known issue. If you look at the 30-year data from, once again, the Fred, you actually notice that they discontinued the 30-year Treasury constant maturities over a certain period of time for I think it was almost 4 years. So here's the options I'm going to pass to this. This is a curve filter I wrote myself. And one of the things I think to highlight is that this process is completely self-contained, including the piece of exclusions. And so what I've done is I've written with it all the parameters within a JSON format, which is readable. And then here's my filter. And then you can see that all the filters are contained here and then processed. So you can add more filters without changing your code. One of the key things here is that maturity in year, I have repeated prices where the second the second value is where they agree at penny. So anything that there's repeated pennies, I drop. And at this point, I'm using maxes, but that's another thing that you can change. And that does have, this is one of those choices that you make that does impact results. So you have to be aware of that choice. So this is a quick run of it. And so you can then see I'll put the filter, and then now we can look at what the results look like. And so I have a discount calculator reviewer, so I have multiple different discount methods for different estimators. And so I have a bootstrap estimator. I have a simple linear model. But this is the idea is that you can reuse the calculator review for each of them so that you can then see how good your fit is. And with the idea of you want to know how good are your reporting or how good of a fit do you have on the yields that were yields from the prices versus what you're then going to calculate using F of U. And so what you can see is there's actually a pretty solid fit. And here's the errors at the yield hat. And you can see that where you have lots of observations, there's definitely more noise down here. But as you move within 3 years, you're well within a tenth of a basis point. So the next question is now you've got looks like a solid fit. How well do you price zeros just as one more step of sanity? And so key thing here is that you want to recover them as well as possible. And so you get actually at between 5 and 95%, you have basically the price difference is 2 pennies within a bid-ask spread. Which is well within bid-ask spread. You do have 2 outliers, and they're at the roughly 21 years. And you can actually look at those on the curve, and you can see that they're significantly price mismatches. And it brings up another problem that I think Christian and Nick have talked about, which is you get really noisy data, and treasury data is really noisy. At times, treasury securities have multiple uses, and so you have to be aware of that. And that impacts people's consumption of them. So people use them as parts of repo strategies, that people use them for beyond just their own financing. They use them as parts of other derivative strategies. And so they also have what's a deliverability element in futures. And so that all impacts how much value are their prices at different times, and something to be aware of. The next step is then going to be figure out we've priced zeros, and now you want to look at U.S. Treasuries, coupon bonds. So these are going to be how well we price notes and bonds. And so here's the yield to maturity. Now we're pricing and so now you have one thing here, and you can notice that under 10 years, you're getting solid prices, but then you have this breakout issue after 15. After this, you've had this dead point in data. This is something we're going to talk about more because ultimately this is an element of the data in that these prices are part of these prices were I got from a vendor, but this wasn't their main strategy. This isn't their dominant strategy. This was their secondary strategy. And they didn't provide prices across at the same, very many prices at the same time and date. So what it looks like is you're seeing the impact of the on the run versus the off the run curve. And so that's a concern, is ultimately how do you get better on the run prices to get better pricing at this long-term conversation.
So is this a liquidity problem? I mean,
yeah, part of it is a liquidity problem. That's what I'm talking about. Off the run, off the run, on the run. That's exactly what I'm getting at. Is that there's securities that are on the run that people trade consistently, and they have better pricing. And then there's securities that go off the run and have less utilization, and it's important. And it's in part determined by coupon and some other factors. They become less priced. People have less information, less observations, and it's problematic.
okay.
So yeah, it is a liquidity problem, but it's ultimately you're dealing with what data you have. And so I'm going to talk about some of the resolutions to this in the next steps. So quick overview of what we've just done. We've had a process review, and remember, we've looked at the data, analyzed it, and we've talked about exclusions, and then ultimately cut it down to our estimation set. Then we fit the model with a key element here. I'm going to make a couple of notes here. Your fits should be automated because these are, and as usable as possible, because you're going to have to do this repeatedly. And if not every morning, then twice a day in certain cases, especially if there's changing rate environments. And then the longest part of your process should be an involved model review where we have agreed upon plots and data elements so that you can understand, are you performing? How are you doing ultimately in sample? How are you doing out of sample? And what is the quality of that data? So, because that's going to be a major issue, and people are going to want to talk to you about how confident you are, or how confident are you on pricing? And that's how it'll come up to you. And this is how you can answer that. So what are the next steps? So better bond pricing data. So I only had one observation per time period for the later elements. And if you looked at the prices in the later bonds, the prices of the bonds themselves versus their strips, there was some significant mispricing. And so that ultimately is a liquidity issue. And it's going to be about using a pricing service such as JPM to then get significant pricing, to then make a decision of what's your on the run and off the run curve, to then decide what you decide what you include in your estimation set. So better data. Where do you go from now? It's at this point, if we're happy with the discount curve, where do you go with the discount curve? So immediately you can start to talk about how this fits something like the constant maturity curve, which there's actually a good match here. The other thing is, right now I'm just going to talk about USD securities and USD mortgages. But one of the first things you're going to have to do is estimate the Freddie, the FHLMC 30-year and 15-year mortgage rates to then feed someone's prepayment default model as part of their refi incentive. So that's the next step. So that's the next step. And then where it really gets fun is then going out and estimating a framework for simulation. And so using a HJM framework or one of its implementations to then estimate what that volatility service looks like. But now this is one of the key things, and is that you now need data that's in terms of treasury. So you need treasury related derivatives, not LIBOR derivatives, that you can then estimate the volatilities of those securities. That additional data is a major consideration, but it's increasingly available as there's been a migration, as we've already talked about, from LIBOR to the overnight rates, which is only one rate offered by the Federal Reserve. So we've talked about next steps, which is better data where it's available. We've talked about estimation, simulation. What simulation brings is a couple of things. So it leads you to a much better set of analytic metrics, and it allows you to then price the additional options in an expected value framework, which adds a huge amount of value from a perspective that you can then begin to understand complex securities performance across different rate environments. It's not perfect, and it won't replace scenario analysis, but it will allow you to then analyze and it'll allow you to calculate option adjusted spread, then calculate the option cost as the difference between the Z spread, which is just the spread of the security over the spread of the security over the yields used in the P0 sub T. With that, OAS and option costs give you some real comparabilities across complex securities, because what you may see is, oh, I've got the same yield, but now you can begin to understand, am I taking additional risk, or is there additional volatility in that security, and how much is the options that I've sold to the other participants in the structure. And then you get better estimates, and this is the reason I talked about duration, is now you can, with your parallel shifts, you can now similarly create effective duration and effective convexity estimates of those same securities. So get better estimates of duration and convexity that account for the changing interest rate environment and the risk that it poses. So I've already talked about why it matters to some degree, the embedded options, complex structures, the common duration metrics, Macaulay duration, which you'll see all the time people ask you about. But Macaulay duration assumes constant cash flows. This is not the world that you in the structured finance world live in. So here's again my contact, and here I did some time. I presented this as an IPython notebook so that you guys can access this and look at the data and do some of your own work with this and begin to extend it along the lines I've already talked about. But here's some of the data and analytics providers that I've used in this space. And so Fred, the St. Louis Federal Reserve Bank, I referenced the 30-year CMT, which is this swaps, the 30-year swap. The big three in mortgage-backed securities and structured credit are Intex, Bloomberg, and Yield Book. Intex is actually the one that provides you the most control, but it's also the hardest to use, and they don't provide a rate environment. Whereas Bloomberg and Yield Book both provide their own BGM-like frameworks. Today, I used Python and Anaconda. I'm not saying it's the way to go, but it already includes a lot of nice features, which are pandas, matplotlib, NumPy, SciPy, Seaborn, stats models. So as you move forward with fitting your own models, you can do it all in one place and integrate those features as part of a larger delivery of not only one interest rate, but would it be multiple interest rates. If you so desire, this is a place where contributions in the open source are great. There's been a lot of work done at QuantLib, and there's a lot of stuff from GSL that you can use if you're required to work in the C++ space. Finally, Boost gives you good dates, which date libraries are really important as you move forward. Pricing, when you have really tight bid-ask spreads for known securities, the bid-ask spread matters. Now, if you have really variable cash flows, it's not as important, or you have significant credit risk, not as important. And then I've gone through a series of books that over the years I've worked with, and to give you guys some feel about where they come from. Professor Liu's book is actually quite good, and he was a quantitative developer in fixed income at Citi for many, many years and worked with Blackbeard Hare. And it's a very in-depth book. If Stefanica is, still think he's the head of Baruch's program, and they have a very applied approach to financial engineering. And then Tuckman's fixed income securities is still the best. It's in its third printing. The first printing was 275 pages. This last printing, 605. That gives you a feel of how much fixed income's changed in just my 15 years. And then you can go through the rest yourself. Mortgage-backed securities, there's a series of them, but Schultz's is the best intro. Joshi's design patterns is dated, but really has a significant amount. When I say dated, it's really written at C++ pre-11, and we're in 20, which is some degree of importance. But he really talks about how to solve complex securities using object orientation, which is really valuable and can simplify your code. Because one of the key things that comes out of this is with object orientation is write your code once, use it everywhere, so that if you find bugs, you fix it in one place and you don't have the reappearance of bugs. And then here's my data tools, and then my interest rates framework so that you can access all the tools here. And then this talk is in Speaking FSU 2011. And if you're so interested, at the bottom, there's a lot more detail on the exploring the differences. Okay, thank you guys.
Thank you, Steve. This was great. I like your Jupyter notebooks. Now, anyone can access these notebooks from the web page, and then they can run these programs, correct, on Jupyter?
Yeah, I haven't added the wheels to the executables yet, or the wheels to Python rates or data tools yet, but I will. But if they were to download the supporting data elements and then add them to their Python path, yes, they could run this whole thing just like I did it. That was part of the reason I wanted to show them this, was so that you could begin to have something to work with a view of thinking, how can I change it to then meet my needs or my requirement? The C++ is a much more involved install, and that's the reason I didn't do it in C++. It's great. QuantLib brings a massive amount of tooling, but it's a significant install on Windows.
Okay. Okay, thank you. Well, our next event is the job panel, and it's already 11:32, so maybe we should quickly switch to the panel mode, which is the panel consists of our speakers and also two visitors that I mentioned earlier. Marina Balzac from City Tampa will be joining the panel, and our former student Daniel Weingart will be joining. I'm not sure if they're already. Marina is here. I can see her. I'm not sure about Daniel. Maybe he is. This part of the symposium will be moderated by Ling Zhu. Ling, I'm going to mute myself and then I'll let you do the rest.
Oh, okay. Welcome to join the job panel. So like, so for the students, if you have questions, like you can type in the chat box. So I'll relay your questions like to all the speakers. So let me start by maybe asking like you guys like about, for example, like I mean, I myself like worked in a bank for 6 months, like before. I mean, after my PhD, before I moved back to academia. But my understanding was that like 7 years has passed since then, and a lot has changed on the in industry. And so I'm wondering, like, so I have two questions. So my first question is like, what kind of like quantitative skills like do recruiters like look for these days? Because my understanding is that like one was graduating from the PhD program at that time, like machine learning was not like talked as much as today, and also like I suppose like perhaps like for the interview questions, etc., like probably the recruiters would expect something like different, like nowadays compared to, let's say, 5 years ago or 10 years ago. So that's my first question. Anyone wants to like jump in or any comment?
So maybe let me take a stab at this question. My name is Marina Balzac. Just to quickly introduce myself, I lead foundational credit risk modeling team for Citigroup. I work out of New York, but as Gray pointed out, we do have a very strong presence in Tampa. We do extensive quant recruiting, and it's for various areas. I work in quantitative risk and stress testing, and in the past 12 months, we have hired 200 quants in New York, Texas, Tampa, and Warsaw, Poland. What we look for. We look for different things depending on level. I think since most of you are students, probably what's most relevant is the more junior positions. For more junior positions, first thing we look for is the strong quantitative backgrounds. It's not specific to Python or R or SAS. Those are all tools that you can learn, right? We look for foundational skills. Can you do math? Can you program in any language? Can you communicate? Communication skills are really critical, and they're more so critical for quants, right? You have to be able to communicate results to non-quantitative audience. You have to give intuition behind your formulas. This is what we look for when we interview.
Any other like comments or
I can also speak about it. So as I mentioned before, I'm coming from training where I actually was leading front office quant teams for many years, and then I switched to investment performance management. So there are three major categories of positions for quants right now. It's trading and short-term investment strategies. You have risk, and risk is model validation, model risk, audit. In fact, I think that Marina is part of the what I call the risk category, and then you have the investment risk management. So what happens is that the tools, let's say that for the first two categories, the tools which are needed are much more stochastic calculus, certain programming. It's much more quantitative, much more mathematical, or much more along this sort of those are what is needed for investment and wealth management. For example, there is no need. We don't use stochastic calculus. We don't use C++. So for us, it's much more about numerical methods to actually. I agree with Joanna. It's very important for the students to be able to explain what they are doing, why they have chosen certain methods and not something else. Why to explain what they have done in non-mathematical terms, literally without using any mathematical equations, because we have to show evidence. We have to convince our partners, primarily life and business, and they are not going to care necessarily about mathematical formulas. They are going to care about the results. So it's right now in terms of programming languages, we are primarily using R and Python, and we are also using to some extent MATLAB. I used to program much more in C++ and C#. Right now, it's on investment and wealth management is not needed. For now, going for example for trading or for let's say trading companies, either trading with the banks or trading companies, it's quite different than going for investment and wealth management. It's the type of data is different, the type of modeling is somewhat different, the type of programming tools are different. Right now, for example, also we don't machine learning is becoming more and more important. However, the main difference between machine learning and let's say optimization or solving PDEs is that there are many more tools available right now which are already implemented in packages. So which means that it's much more important for the candidates to actually be able to find those packages and to sort of to know what to test, how to test, to decide which ones are good enough, because actually vast majority of packages are not necessarily good enough for particular purposes, because either they don't have enough testing, they don't implement necessarily the better methods, they don't have enough documentation, or even if these the categories are satisfied, they may not be good enough for that particular purpose of the project. So one other thing that to mention is that right now it's much more difficult to, so out of the three categories, it used to be that the first category in terms of trading was the one that had the most promise. Right now, that is the one that has the fewest people actually, the fewest sort of positions. The second one, risk, is growing for various reasons, and the third one is growing even more. Now, the third one, in which I am, investment and wealth management, what happens is that it's not very clear. So it is known that the industry needs to be much more quantitative. It's not very clear to very senior management exactly what they need to have and what type of skills for the positions. So that's why it's quite different compared to, let's say, the first two categories, where, let's say, for trading, you would have had a trading desk would come from, let's say, some other company and would know, okay, I want to have those particular models, I want to have those particular software tools. For investment and wealth management is much less clear. So what also happened is that so right now there are many more candidates compared to even 5 years ago and fewer positions. So we had, for example, last year we had 2 positions for junior candidates. We had more than 100 candidates. Out of those 100 candidates, at least 80 were qualified now. And obviously we cannot even have first round interviews with those 80 candidates. So right now, my strong suggestion to candidates would be actually to focus on 1 or 2 projects that are deemed to be practical enough for a particular, let's say, topic. And that project doesn't have to incorporate anything new. It may be even like an overview. And then to have that, to actually show it to people in the industry, and to go that route rather than just sort of use their degrees and their GPA. It's not enough.
Yeah. Okay. So another question I have is that, I mean, a few years ago, I remember that at that time, it seems a model validation, model government like has a lot of like job openings and then also like the risk management. And so a lot of students applied for these positions. So are those like still like the area where like you have the most job openings now, like in financial industry, or are there some other directions where like you are doing extensive like hiring? And also like I'm wondering like what are the most popular jobs actually the candidates are interested in these days in financial industry?
So I can't speak to popularity of jobs, but I can speak to risk management and the types of jobs that we have. I think Christian correctly pointed out that there are a lot of jobs in model development and model validation. So you need people to build models and people to validate those models. Both of these require very similar skills, and there is a lot of mobility between these jobs. Somebody who may develop models for a few years may move to validation and vice versa. Governance jobs are very different. It's a different type of a skill set. You do benefit from having quantitative skills, but this is where your communication skills, knowledge of regulation, ability to put together materials are much more important.
Any other comments? Or
yeah, I can talk a little bit about popularity. I think in my experience at Wells when I joined, it was pretty interesting where we all kind of, all the new hires joined where we were kind of competing for different positions in either working on the trading desk or in model validation or in market risk. And I think from the beginning, it was very obvious that the most popular positions that people wanted to work in were on the trading desk. And I think if that's what you want to do, you have to be aware that it's going to be a little bit more competitive, and you really have to find a way to make yourself stand out and sell yourself as someone who's strong.
Yeah, I also want to quickly add this is connected. The types of jobs is connected, I think, to the question of the skill set that is needed, right? And you mentioned model validation, and I think what happens is every few years something happens, and there's a plethora of jobs in one particular thing. So those model validation, happened because there was this regulation, SR 11.7 or whatever it is, or, that had these jobs and it required a certain skill set. Now there's a lot of data science positions that don't require, the classical stochastic calculus, require data because data is proliferating and people want to check these things out. And I think if I was, the question then becomes, as a student, and I think this is what you're getting at, what should you really start focusing on, right? And I think some of the panelists have kind of nailed it that, you can't really predict what was going to happen even 2 years from now or a year from now. Things can happen. So, but the fundamentals, people, want someone who can be flexible, and to be flexible, you need to know fundamentals, some basic statistics, some basic programming, some basic calculus, and some, and know that well. And then, it sort of like, if there's a click within the group or whatever it is, and you find that someone can learn, then that's fine. So I guess what I'm trying to say is, if I was a student, again, just focus on all these three things, but the basics of them and know them well, and not try to chase sort of, unless you really want to be in one particular area, not really chase one particular skill set.
Yeah, there's a question from Girai, and so he was asking, like, are you interested in students who have knowledge in financial regulations and law in addition to quantitative skills?
Absolutely. What I find is that students often don't read job descriptions, right? If a job description says Basel or CCAR or ICAP or SR 11.7, please Google what it is. It will really put you ahead of many others, right? You don't need to be intimately familiar with the rules and regulations, but at least know what it says. All of this information is so widely available. Being prepared for an interview is really, really critical.
Okay, yeah, there's also a question from Dario, and was asking like a recent Bloomberg article mentioned that some of the quantitative funds have been underperforming in recent months. So in your opinion, what is the primary cause for this?
Well, most of the quant funds actually are doing something which is much less quantitative than you imagine. So when you are hearing about factor-based investing, well, these are supposed to be quant funds. Well, they are using linear models. So the fact that they are calling themselves quant funds doesn't necessarily mean that it's a different type of, the modeling on investment and risk management is much lower compared to that on the trading side. So the meaning of quant fund is actually very broad. So there are some companies which are actually very successful, very few. So most of the hedge funds right now are not successful because they are not quantitative. Well, there are only two types of companies which are very successful right now. It's either they, or that was true actually last year. So right now it's somewhat changed, but it still remains true. So either they are very, very quantitative, like True Sigma, or they are very niche, meaning they have, for example, they have knowledge, specific knowledge on, let's say, credit products in European companies. In between, you have a lot of companies who are sort of quant, but it doesn't mean necessarily that they have good enough methods there, even if they call themselves quant. So it's the quant sort of companies are covering describing a much wider sort of type of companies that you'd imagine. So it's somewhat misleading what they are doing in terms of they are not very quantitative.
Mm-hmm. Yes, there's a question from Ibrahim asking like, are there some special like model validation like positions that are primarily just to review and validate models that use machine learning?
To validate models using machine learning. So mostly it's used, I can say, at Citi for specific areas that lend themselves to machine learning techniques, such as fraud or marketing. We do not really use machine learning techniques to develop regulatory models because nobody wants to sit across from the regulator and explain why those results were produced.
Okay.
So within Citi, there are in fact jobs where machine learning is used. Again, if you're trying to identify fraud, right, on the credit cards, whereas there is tons of data and you don't need to explain those models to the regulator. So marketing, who do you target for different products? So for those models, machine learning may be used for both development and validation. However, with the regulation around machine learning and all the additional testing that is expected, benchmarking, et cetera, it's a very complicated thing within banking.
One question related to that. These benchmarks, who decides about those?
Who decides the benchmark? Benchmark is a requirement for a model, right? So you have to have a benchmark for all of the models. Just as you need back testing, et cetera, you need to have a benchmark, sensitivity testing, et cetera.
There's a question from Alex, like he's asking, aside from proficiency in math programming, does industry knowledge and experience such as the SIE and the series 86, 87 exams or others play a strong factor in the application process?
No.
No?
No, because the candidates, whenever they become employees, they have in the first 4 months, they have to pass those exams. Mm-hmm. So it's now, if you have them, it's better, but it's not a requirement.
Yeah, we don't look for that. If we do have people coming with CFA or FRM, I would say those candidates do have a leg up because it shows a lot of product knowledge.
Yeah, I think it depends on the role. I would say that these kind of things do help in certain roles, especially in research roles where you're working on particular products, you're working in, you know, in equity research. And there's little things are becoming more quantitative in equity research, all these things like price to equity ratios or whatever. There's a lot of machine learning, a lot of just basically quantitative stuff. People used to do this in Excel spreadsheets. Now they're automating this. So that, as an example, you know, this is another thing we didn't talk about. There's a lot of automation going on. And that's a really big thing where they're just taking things that people used to do in spreadsheets on trading desks and just saying, look, can we automate this? Do we need to do this? So there's a big push there. It's more technology. But if you have someone who understands products really well, and they show that through the CFA, through doing some of these exams, this Series 7 and, you know, a bunch of the equity ones, that shows a little bit. For other roles, I don't think it plays much of a importance, but for some it does.
For fixed income, the FRM was really helpful. I didn't find the CFA very helpful. FRM made you read Tuckman, made you read a couple of other books. I found that very helpful, and it ultimately exposed you to a lot of the details that are important. And then as you move within fixed income and you're a quant, you're going to be expected to have that deep product knowledge, especially in structured credit. It's important. And then the other place in fixed income it's important is if you're doing, as you move down the credit scale, and so you do distressed debt, which is one of the higher yielding spaces, people with law degrees have a comparative advantage. But you're not a quant at that point, because really what's going on is you're participating in a workout and optimizing a workout. So there's some interest there. There's a couple guys that have graduated from Florida State that have done that. It's been interesting. So I would say the FRM is helpful, and I think it has real value. But your basic quant skills, I think, and broad quant skills, as you guys have outlined, I think are important. It's not just stochastic calculus that people are going to care about. What they're really going to want to be able to do is, you know, can you solve linear algebra problems? Can you estimate using linear regression models? Can you look at estimators and say that's a good fit or a not fit? That kind of stuff all has real value that you're going to start with as you move forward. It's going to just be more important to things like linear algebra and statistics, because you're going to deal with more and more complex securities. And I think I would press people to say, not just to learn the options theory, but really understand that when you learn it, you're really learning instruments that are going to become Legos, that become part of a bigger, more complex process. And so it's really important that you understand them really well and how they're going to fit as part of a larger, more complex security that's going to be offered to the market.
Right. So there's another question from Samuel, and so he was asking, what do you think the industry will look like in 5 to 10 years? Like mostly focused on machine learning, or any big pushes in some other like technical areas?
That's a hard question. I think the big thing that you'll see, one thing is, and I would love to hear you guys' perspectives on this, is I see machine learning appearing more and more as part of strategies to remove voice trading. I think you're going to see more and more of that. I think there'll be voice trading for the really complex stuff, but for a lot of things, it's just going to be gone. I think that's one thing that'll be important, but it'll make quants and quantitative developers increasingly more valuable, because there's one key decision that you have to make is, are you going to be a true model builder, or are you going to be someone that's at the intersection of model building and trading, or model execution, as you might call it, in which communication is really, really important, because you're going to have a big part of your day is going to be trying to explain to somebody why this didn't work, or why they didn't get results that they expected, or.
Yeah, so I would agree with you there. Like electronic market making and execution in fixed income is going to be a big thing. So right now, you know, FX, equities, you do not much voice trading. You don't pick up the phone and say you want to buy 100, you know, the shares or something. But in a lot of bonds, especially in high yield and distress that may or may not, change that much, but it's still voice. You still have these guys, old school, picking up the phone, making all these deals, and that's going to change. There's already, bond IT. There's a couple platforms that are dedicated to electronic trading, and that's where the big push is. And it's a silent push because you don't see them, in the forefront. Like when you talk about these quant conferences, you don't really see that as much. But there's a lot of hiring, a lot of development because liquidity isn't there as much in the corporate bond market, and that'll change. So that's where I believe in 5 years is going to happen. You get electronic trading in the corporate bond world.
One area that you are going to see so right now positions also are open for the so-called data science teams, which sometimes they are very quantitative, sometimes they are not. Going forward, so right now machine learning actually is becoming relevant primarily because of a few reasons. You have these many more available packages which are already implemented, plus senior management actually, because this is such a hyped machine learning right now is very hyped, and they heard about it and they heard that it's going to work in various areas. Why not for us? It's for investment and wealth management. This is definitely a push. It's not working well, and unless they are going to cheat. The problem is about data, but also about the methods. However, you are going to see more and more usage of that, primarily in combination with some better methods which are not machine learning. Primarily because the level of modeling on investment and wealth management right now is quite low. It's also that there are so all the banks right now are actually pushing much more for investment and wealth management compared to trading, because that is where, frankly, the money is for them. So there is more and more competition there. So they are going to have better tools. Right now, all banks have this hybrid model of they go for the hybrid model of robo-advisor plus human advisor, because they found out that clients actually they need to have sort of human hand-holding in cases of crisis. So but then that combined with the voice recognition given by machine learning, combined with NLP, combined with all the other machine learning techniques, this is going to make the investment experience much different in 5 years compared to now.
Thank you very much. So there's a question from Samuel and also from Giray. I think they are kind of related. So Samuel was asking, how should a first year or second year PhD student do the best to prepare for the industry job? So basically focusing on the basics and then get some practical project. Is that something you think is a good strategy? And the Giray's question is, I think essentially because machine learning has so much hype these days. But how about traditional numerical methods? Students should learn about. How about, let's say, numerical PDEs, Monte Carlo simulation, numerical optimization? Are they still highly relevant today?
They are much more relevant to the trading side and on the risk side and on investment management. We are still using, it's good to know the numerical optimization and simulation, but for example, we are not using any PDEs, and I don't think we are going to use soon. It's in terms of knowledge, I would say do not learn too much in terms of the depth of machine learning, but much more in terms of how it is used. What are when to use certain packages, when not to use them, when to use certain methods, because there is a lot of hype and there is too much to learn about machine learning right now. So now it also depends which area they want to go to, because if they want to go for, let's say, trading or risk, then you need to know stochastic calculus, you need to know much more of these sort of traditional methods. If you want to go for short-term investment strategies or investment and risk management, this may not be as required. But the emphasis should be on the projects, on the practical projects. This is the part where most students don't do them. They don't, and if they do projects, they are not practical enough or they are not relevant enough for the industry. And those are, so out of those, let's say 100 candidates or more that I have mentioned, I don't think that more than 5 of them actually had good enough practical projects. And those projects were not related to investment or risk management. So that's why actually I started to have projects with students on the on universities in primarily in New York area, but in other areas as well, for this type of practical projects, because they don't have them and they get some projects which are, well, they may sound nice in theory, but in practice they are not good enough. So, and there's a part that right now the students don't have it, and there are too many candidates, and you cannot differentiate based on GPA on the coursework. It's because for us it matters much more that they have intellectual curiosity, and actually they can explain and they can sort of show the procedure, how they have selected particular methods, how they have sort of done the literature review. It's much less about, okay, certain very in-depth sort of theoretical questions, which are nice to have, but okay.
I completely agree with this. We get resume books and all of these resumes look exactly the same classes, the same high GPA, and same descriptions even in often cases. And these projects is something that can differentiate you. But if you do get an interview, ability to speak to those projects, to describe the methods you chose, why you chose them, what was the end goal, what were the difficulties, you know, what were the surprises, what was the outcome, how you thought through things, right? Showing this intellectual curiosity is what will set you apart from other candidates.
Yeah, so I want to, speak to those points, which are, I agree with that. And, when they're asking about PDEs, what is it, Monte Carlo simulation, numerical optimization, the projects are important because, if I have two people, one is someone who really understands the method, but can't code up a model and actually do the numerical optimization and have a model done quickly. And the other person is someone who really doesn't understand unfortunately, it's very sad, but really doesn't understand the technique that much, but actually can, code up a model and do some optimization and have you a model like that's functioning and working. The one you're probably going to pick is the one who has this experience building that model. So even if their understanding isn't as great. So, and that's just the nature of the thing. So having experience with some projects, showing that you can go end to end, not just understand something, but actually was able to build a model and have some output. I think that's very important to show.
Yeah, and if you can get it on GitHub, I think it helps too, because then people can see the full project and it gives them a chance to play with it. And it ultimately leads to that really important conversation of why did you make these decisions, which I think is what really differentiates you. Because you talk to a lot of people who say they know C++, and you start asking them basic questions and they can't answer it, or they don't even realize that how complex of a language that is, or that there's 4 ways to do it in C++.
And that is actually, so that's why it sounds strange, but you may actually, the students may need to decide in which direction to go, because, for example, if they want to go to investment towards management, they will not need C++, they will not need C#. And it's, however, there are positions which are actually, you also have to be careful about what the position is saying. Some positions, they say quantitative, but actually they are just programmers. And that's, from my perspective, those are not quantitative positions, it's just programmers. One example to say what, like the type of the answers that we got that we didn't like from students, we were asking, why do you choose this method? We have been told, well, this is what my professor told me. And as you can imagine, that is not acceptable. So it's in the, so the other part to have in mind is that the all the interview process is going to actually have multiple stages, but one of perhaps the first stage is going to be the HR is going to receive a lot of resumes, and because they may have, like I was given the example last time about, okay, 2 positions, 3 positions, more than 100 resumes. We actually look at all of them, but it may happen that the HR actually may be asked to do the first cut. And in many cases, they are going to look for the keywords, they are going to look for the school. And so that's why one of the advantages of having such projects is actually you can reach out directly to the people in the industry. You still have to go to HR process, but then you don't have this problem where, okay, only because some student, so because there are so many candidates, And you may have situations where you have students from Florida State, students from Harvard, students from Georgia Tech. It's likely that if they have if HR is not going to be given indication how to do it, they may simply say, I'm going to choose a student from Harvard and don't choose the other one. So that's why it's sad, but it's very important to actually get in touch with people in the industry and to connect with them. And the projects are going to help a lot actually to have that part where you can differentiate yourself from somebody else, because the projects are not going to matter whether you are coming from let's say some small school in somewhere in the middle of America, or you are going to come from here. If the project is good, you are going to actually be chosen based on that. Not chosen necessarily as final selection, but at least you are going to have the first round of phone interviews, because that's the most difficult part when you have too many candidates. How to get to that first round of interviews.
Mm-hmm. So there's a question from Peng for you guys, but like I just want to say, because of the time constraint, so like if you want to like ask like one more question like to the speakers, let us know like in the chat box. Like we will have time only for just one more question. So the question from Peng is that like so machine learning like basically like involves like using some open source packages and libraries, right? And so like if you work in a bank, do you have the right to use any package library you like? Or like for some security reason, like there might be some restrictions like in the bank in terms of using open source packages?
In most cases, you have to go through more to acceptance of being able to use the packages. Also, it depends on the license for those packages, because some licenses are somewhat restrictive and you cannot use them. So it does depend on the package. It does depend on the license and the package, and also the process within the bank. So for us, we cannot use any package without a team was sort of looking at it and sort of saying yes or
no. Daniel, like, do you want to follow up or?
Yeah, I just basically want to agree with Christian, but also say that in model validation, we have a little bit more freedom than the developers to kind of choose packages. But even though overall our teams can really choose almost any package we want, we still need to go through like some process of going through like our IT governance to decide what we can and can't use.
Mm-hmm. Okay, maybe let me ask the last question like of today's job panel then, because like a lot of our students, they are in the PhD program. I mean, some of our students are in the master program, but a lot of students are in the PhD program. And so I think when they are graduating, like I know quite a number of them like actually like got a job in Amazon and also like Yahoo and some other like technology companies. So what's your opinion about like the potential and the future prospect if let's say, imagine if you were a PhD student graduating, like would you consider like those tech companies first, or you would consider like a banking industry first? What's your opinion on that?
So
I think it.
So let me. I'll try to explain my view on this really quickly, because you know I've had this question a couple times before. And one thing is that my view is, and other people might say it different, but my view is that banking is the product is financial products, right? They're new issues, and then you support this new issue with secondary trading. And there's a whole bunch of things, and quants are in the background of this, right? They're in the background of this, supporting that effort. The effort is really, issuing bonds and issuing loans and doing all these kind of structured products, and we're in the background kind of supporting that. And so our view of the banking world is a little bit different than actual bankers. When you go when you talk about Google or Facebook and Amazon, their product is a tech product, and if you're a technology person or a quant in that place, you're very much closer to the actual action, right? The actual action in the bank is not really building the models, but that's support for the actual action. So there's a little bit of a difference in terms of how close you are to the real output in the final product between those two. And that, from people I've talked to that have switched sides and both sides, the actual day-to-day work is not that much different. Maybe there's a little bit more intensity in the amount of data that those other places have, that the tech companies have, and the amount of machine learning people that they have. But in general, the day-to-day work is different. It's just what, at what point on the food chain or how close you are to the actual final product. That's my opinion anyways.
Yeah, so my opinion is that, so when I was graduating, I was super stressed that I wouldn't be able to find a job because I didn't think I was really that competitive to get a great postdoc and end up being a professor. And I was really shocked to learn that any PhD in math is actually very valuable because you can become a programmer, you can become a quant, you can become a data scientist. And I really think you can even prepare for interviews and get ready for all of these any of these different industries in about maybe like a year to 6 months. So I really think the beginning of your PhD, you can focus on finding a really good thesis project, passing your quals, and then later, as you get near the end, you figure out what you want to do with your life. You can figure out what you want to go into. And I just want to sell a little bit of being a quant, especially in validation. I think if you like math and you want to work on kind of like deriving formulas, thinking about convergence of different methods, you actually can do that as a quant, especially model validation. We think about these questions all the time when we see these different models. You might see people who have brushed through certain derivations and you might be like, oh, these guys missed a convexity adjustment. Or you might see someone's PDE method and test it out and you might be like, oh, this doesn't converge as fast as I'd expect. And a lot of people will even tweak these methods. And so suddenly you have to rederive all sorts of new things. So I think if you want to do math and you really want to think about the stuff you learned about in school, being a quant, especially being a model validation, is like great for that.
Okay, so if we don't have more comments, I think like probably we should conclude like the job panel today, discussion today. I mean, thank you so much for your time. And so now I will turn to Girai to conclude like the symposium.
Okay, thank you, Ling. I want to thank our job panel for their feedback, insightful feedback on industry-related, employment-related issues. I want to thank our speakers one more time. And I also want to thank our college, Heather from the College of Arts and Sciences and her team who, worked behind the scenes to set up this Zoom meeting. Just a reminder that you will be receiving an email with a link to the videos, to the YouTube site. And the slides are still available, but I will be disabling that feature later today. So if anybody wants to look at the slides, please do that after the workshop, and probably later tonight in the evening I will disable them. And that's about it. I hope you will have a good rest of the weekend, and thanks again for attending and for being in this symposium.